Hey guys, Ken Boyd with the Accounting Accidentally website, where if you can find over 500 blog posts on accounting and finance, and also if you scroll down to the middle of the page, 400 YouTube video links. So I wanted to talk about this blog post, what Las Vegas conventions teach us about relevant costs and special orders. So it's July of 2021. A lot of conventions are starting to come back in a post-COVID environment. I know people who go to these types of conventions for a lot of industries, and these events can lead to large orders and new business relationships, which is why people head out to Vegas in the middle of the summer. But the real question is the business that you gain at a convention profitable? And specifically, what price do you charge on a special order to generate a reasonable profit? This is a business topic that is neglected by a lot of business owners because special products are priced differently. Not all of the firm's costs apply, and this is neglected by a lot of people who price their products wrong and decide they can't take on business when they really can. So let's assume that you manufacture outdoor sporting goods and equipment. You head to Las Vegas for the trade show. Potential customer wants to buy a large order of Tundra Tough hiking shorts, and so here are the costs: sales, direct material, direct labor. You're selling the product for $100, direct costs $80. You have indirect costs or overhead of $5. Total costs are $85, and your profit is $15. 100 less 85, or 15%. Remember that direct costs can be traced directly to the product, in this case, a pair of shorts. Overhead cannot be traced. Instead, it's allocated based on a level of activity. Direct labor hours or machine hours are often used to allocate overhead. Those are the activity levels to allocate. Here's the key point: why a lower price can still be profitable. If you receive an order at the end of the month, many of your indirect costs are already covered. So assume you're at the trade show at the end of July. You've already paid the July lease on the factory, the July utility costs. Your prior production paid for these costs, and this is the key. The result: you don't have to allocate indirect costs with a special order. They've already been paid for, fully paid for in July. All you need to charge are the relevant costs of production. So what are the relevant costs? Well, a relevant cost is one that changes based on a decision you make. An example I've used for years is, if you can imagine a commercial flight's leaving in 15 minutes, almost all of the airline's costs are sunk costs, past costs that cannot be changed. The fuel, labor costs for the crew, gate fees, even the cost of the drinks on the flight. And if a passenger buys a ticket at the last minute, none of those sunk costs are relevant when pricing the ticket. The only relevant cost is the labor cost to store the luggage and that Diet Coke the person drinks on the plane. Everything else is paid for. So the point being, when you accept a special order or a last minute order, only consider the relevant cost to fill the order, and you may find that you can price your product at a lower price and get the business and still be profitable. So that's a bit on special orders and relevant costs. Remember also that you can go to conference-room.mn.co and join our community of accounting and finance professionals. You can sign up for free here. Thanks for watching, and we'll see you next time.